For the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, everybody, welcome back to another Saturday send out from the Simple Side. I'm sure you saw our portfolios and software stocks got crushed this past week, but we've been looking at our macro models and we don't think it's an intrinsic problem with the market. So we're going to rebalance and we'll talk about it all right now.
Welcome to the Simple Side. Market beating picks inside. There's no jargon and no time to waste. Join the Simple Side and end up in first place.
All right, before we address the elephant in the room, let me quickly say a few reminders. Copy trading, of course, is available on autopilot. There are links to that in the newsletter. Our portfolios are available to be viewed by paying subscribers on our website, which you can find at thesimpleside.news. So you can find those there. You can also find our macro research reports, our research reports for individual stocks, our weekly picks, and basically anything and everything else on the website. Again, thesimpleside.news. But our newsletter you can find at thesimpleside.substack.com. All right, so those are our reminders that we send out, or I guess that we talk about every single time we send one of these podcasts out. Now we get to kind of ramble about the portfolios and a bunch of other stuff quickly, and then I'll get into what we normally do every single week. So this week was an absolutely brutal week for our portfolios. I mean, across the board, we were crushed, and it was not fun to watch, nor was it fun to feel in our portfolios. With that being said, we're 50% in cash, so watching it happen doesn't really hurt all that bad. It, kind of makes me feel a little bit good, if you will, about it, because we're not getting smoked incredibly hard. While a lot of people who were heavily indexed into tech and software got really, really hurt, especially if they had their entire balance, invested into the stock market. And, most investors, especially those that are writing a newsletter, they do have it set up that way. So I'm glad that we're 50% in cash and we didn't get absolutely smoked. With that being said, it's not fun to watch over a week or a month or 6 months even to watch a portfolio go negative, especially when the market has had such incredible performance over the past year, month, whatever you want to look at, the past timeline. That being said, we invest for a minimum of a year, and a lot of the holdings that we have in our portfolios are 3-year or more time horizons. We're not focused on the short term. We're not trying to make 20% a month. We're focused on long-term holdings. That's what served us well, and we're going to continue to do so. Now, in general, I'm not super worried about the recent market drop. I don't think that AI is going to suddenly render companies useless, especially software companies. Yes, you can build your own apps, and yes, you can build your own software, but then you have to host it, then you have to manage it, you got to fix all the bugs, you got to have your tech support, which is typically another AI program. And the questions that I started to ask myself were just simple truths about the businesses that we own in our portfolio. Do I think companies are going to create their own custom tax software instead of using Intuit TurboTax or Intuit QuickBooks for their accounting, or any of the other companies that QuickBooks owns, or Intuit owns, And the answer is no. I don't think people are going to create their own custom internal software just to file their taxes. It's just not going to happen. Do I think that companies are going to start creating their own custom PDF software instead of using Adobe? Not really. I mean, yes, there are AI models out there you can kind of Photoshop around with and that sort of thing, but in general, I don't think that Adobe as a company is going to go anywhere just because there's AI models out there. You can still pretty much tell when a video is AI, and I think a lot of editing that's done in Adobe is going to kind of remain there. And another thing is Adobe can implement AI programs into their software. It's like, these companies that are getting really, really crushed on these AI headlines, it just doesn't make all that much sense. Another one is Qualys. Do I think companies are going to create their own custom security and compliance software? I don't think so. And Qualys is a great example because they have their own AI agent platform that they've been developing. Why would that company get crushed when these AI headlines are coming out? If anything, these kind of companies that have the ability to integrate AI and are doing so should start rising on that news. But regardless, I digress. So I don't think that AI companies are going to suddenly destroy these software companies. Um, just like Google just implemented AI into their system, implemented AI into their I guess quote unquote software. I think these companies are going to be able to do a lot of the same. Now, that being said, I refuse to believe that I'm going to read the market right 100% of the time. And there's probably a world where I could have predicted that AI companies would go under fire, that software companies, excuse me, would go under fire because of AI fears. And I probably could have slowed or stopped some of the investments that I was making in these software companies. I also think that there are probably opportunities for me to decrease my tech exposure, even though I do have that tech-focused growth portfolio. I probably could decrease the amount of software tech-centered businesses that we own in there as well, just because it is so heavily focused on tech companies. So there's probably some places where I probably could have been a bit smarter, but I do also want to address the fact that given this underperformance, I still think we have a great potential for our total portfolio going into 2026. Again, thanks be to God that we have that 50% cash position, because a 4%, 5%, 11% drop in a portfolio could be devastating to witness if you're 100% invested. So, watching that, basically those returns be cut in half has been a huge blessing because we're not overly indexed into all of our portfolios. In the past, our flagship fund has been between 3 out of 20 stocks in the software sector, 4 out of 20 stocks in the software sector, 9 out of 20 stocks in the software sector at most. And that 9 out of 20 has been this quarter. So the one time that we nearly double the number of companies that we own in the software sector is, of course, the time that they get crushed. And our bottom 3 performers, down 32%, down 23%, down 23%, all of those are software companies. Honestly, I think allowing a volatile sector to kind of be the vast majority of the portfolio has been an oversight on my part. But I still firmly believe that these companies are extremely quality, and in no way do they deserve the sell-off that they received. Regardless, there's an issue in the market, which is the decompressing valuations of these software companies. And it doesn't really matter what I think the valuations of these companies should be. It matters what people are willing to pay for them. If you have nobody willing to buy the company that you own, of course, it's not worth anything. So I see 3 distinct paths. Stay the course, potentially index heavier into some of my higher conviction holdings, and DCA into some positions that are underwater that I still like. Number 2 is to shift the portfolio weights in some of our funds to reflect a lower tech/software focus and make no additional purchases. And number 3 is to shift the portfolios by adding new positions and diluting current underperformers. And I'll address kind of how I think about that later on in today's newsletter, but those are really the 3 thoughts that I have going forward. I still like the companies that I own in the software sector, but like I mentioned, the reality is that if no investor thinks that these companies are valuable, then my 1-year holding period, my 2-year holding period doesn't mean anything, because no one's going to be willing to pay an outsized return price for the companies that we own. So, like I just said, what's challenging about the current market is that you could be 100% correct about a stock and its ability to grow and its fundamentals, but it'll struggle while performative names are going to blow up quicker. They're going to explode in price, and they're going to have incredible performance. So there's really this push and pull that you have to deal with. Again, like I mentioned before, Qualys is a great example. It grew 10% in 2025, EBITDA of 47%, released in agentic AI risk management marketplace, announced share buybacks, and the company's projected 7% growth in 2026, it remains profitable, and it has better growth rates than majority of companies competing in its industry. But after earnings, the stock dropped 14%. 14%. So that doesn't make too terrible much sense. I could have seen the stock dropping a little bit on lower growth, but in general, seeing such a quality company drop so much is really something that I did not expect, and I still just don't understand. Of course, I've been saying for weeks that the marketplace right now, the market, the S&P 500, any equity company is driven almost entirely by emotions at this point. I'll get into why that is in a little bit when we get into our macro section, but just know when things are emotionally driven, it doesn't matter what the fundamentals are, it matters how people feel, and if people feel that AI is going to be diluting the potential earnings in the future, then they're going to sell those companies. Something else, of course, that's very important to think about are the multiples that companies are trading at. If you look at a company's PE ratio, you know that is a value indicator ratio, but we don't really know or think about exactly what that means. We think single digit PE good, double digit PE okay, 30, 40, 50, 100 PE ratio bad or overvalued. But really what you're looking at is the number of dollars that you're willing to pay for $1 of that company's earnings. So if a company earns $100, you buy their stock for $200, you're paying $2 for every dollar of earnings that company has. Now you can turn that into years as well. So we paid $200 for a company that makes $100. So in 2 years, the total earnings for that company over that time period will make that purchase that we made worth it. The company has returned or has made enough money over that period of time that our earnings are equal to the price that we paid. You can think about it as well. If you pay $200 for a company, in year one it makes $100, and then year two it makes $90, well, your total earnings are 190 less than your 200, and you paid a 2x for that company, but that company over 2 years is really only worth 1.9, so you've overpaid for the company. And that's a really simple way to think about it. Very dumbed down. There's a lot more that goes into it, but in general, that's how it works. So the question that I am trying to answer, the point that I'm trying to prove, is that stocks aren't always going to follow their earnings one for one, and people are speculative. And I doubt that many people would be willing to hold a stock that they bought for 22 PE for 22 years. I don't think they're going to wait to realize the full effects of that holding. And so the reason I bring all that up is that we're witnessing a loss of faith in the software companies that we own. A loss of faith in the earnings growth, a loss of faith in the revenue growth, a loss of faith in the margins. And so it doesn't matter whether over the next 11 years that company will pay for itself, because we or most investors aren't going to hold for that long. And so really what we're looking at is like investor emotion again. Like if most investors feel that revenues are going to be heavily impacted by AI, you can't argue with them. You can't force them to buy into a company. And so, of course, sadly, we're going to have to wait, 1 or 2 quarters before we see these companies start to come back, because people are going to need to be proven wrong, but proven that these companies can continue to grow their earnings, can continue to grow their revenue. And so we're going to have to wait for that to happen. And again, I say sadly because I'm selfish and I want every stock that I buy to launch to the moon immediately. But a quick overview of all the rambling that I just did. Our portfolios are over-indexed on the software sector. This isn't normal for us, but it just so happened to be our bad luck so far this year. We got hit hard this past week. We are looking at positioning our portfolio differently going into the next few quarters in case investor sentiment around these companies remains low. Stock prices are based on investor emotion in the short term and not fundamentals, so PE ratio and free cash flow multiples could decrease further from here. I think we have a path to recovery in the next 1 to 2 quarters as long as we continue to see earnings grow. And I have an interim plan of attack for the next 2 quarters while we wait to see whether or not we need to fully trim or if we can add to these software positions. Of course, before we do that, I want to talk macro. If you're not following along with this newsletter, you should go and do so. Again, thesimpleside.substack.com, and you can look at all the graphics that I'm about to reference, but you should probably jump over there and pay attention to everything that we're about to talk about. So our general macro overview is driven by a quant model that we have that's running a ton of statistics on a ton of data in the background and then giving us a buy-sell indicator. This is not the fear gauge. This is a buy-sell indicator that's based on what our prediction of the S&P 500 is going to be over the next few weeks. And so what we're seeing now is a light buy at 0.35. This is higher than it's been in the past for sure, but in general, the overall market, we're seeing a light buy, which is great. It's nice to see the quant model not being bearish, but of course we've been riding back and forth between buy and hold territory, and we would like to see this run up to a strong buy before we really start to load up on stocks. And in the opposite vein, we'd like to see it go down to a strong sell before we started to really sell out of a lot of our positions. One thing that you will notice is that our gold ranking has been very strong. It's still rated a strong buy. And I think in general, this is actually somewhat bearish for the current equities markets. Regardless, I think the economy is going to continue to be stable, but seeing commodities go high typically means people are trying to get away from inflation, a declining value of the dollar, and other things of that nature. So seeing commodities ranked a strong buy is relatively bearish, but for the current market, it doesn't mean too terrible much. Now, one thing that I have been paying attention to pretty heavily is the S&P 500 momentum model. Again, I've got an image here in the newsletter that you can go look at. And the nerd explanation for this model is that it's the slope of the 12-month regression of the S&P 500. And the simple way to think about it is it's the pressure of investors, the pressure on investors and on the market. So when the S&P 500 momentum goes really high, it's high buying pressure. The market's going up, stocks are rising, and the pressure is basically on investors to buy into a rising market. Now, in the inverse way, when momentum goes down, the pressure is on investors to sell out of a declining market. Now, I don't use this S&P 500 momentum model to tell me whether or not I should be buying or selling, but I do use it to look at anomalies in the market. So I put a great example up in the newsletter where I've circled, we hit kind of a momentum top. It started declining. And while it was declining, the S&P 500 was still climbing. And so when you see a declining momentum, but an inclining S&P 500, you know that the market is probably headed for a steep drop in the future. And we ended up seeing that. That was around April 2025 when all that tariff news came out. The markets kind of tumbled a little bit. And so we saw that happening. The other thing that you can look for is huge dips or huge inclines in the momentum. Typically after a huge dip, it's a great time to buy. Typically after a huge climb in momentum, it's a good time to sell. And so we kind of use it for that sort of indication. But the way the momentum looks right now is pretty strong with a potential to level off in the next couple of months. But in general, there's no surprise that the market has been running high and hot because momentum has just been picking up since that April timeline. So no surprise there. However, on the opposite vein, we've got the insider buy-sell ratio pulled up as well, and we've seen insider buying increasingly decline. I know that sounds kind of counterintuitive, but it's been getting less and less and less and less and less every single month, every single year since about 2022, late 2022, early 2023. So insiders are basically calling it timeout right now. And of course, over that same period of time, we've seen the S&P 500 run wild, potentially even become pretty overvalued. And so it's interesting to see that insiders have kind of stopped buying their stocks. And really what this is signaling to us is that we're not in any kind of dip that's worth buying. But it's still very interesting that insiders are basically slowing their buying almost to zero. We're down to 0.23 is the ratio from buys to sells. So For every buy that is going out, there's nearly 4 sells that are happening in the current market, at least in terms of volume. Now, one thing that I do want to hit on before we close out the macro section, or at least this kind of just like background rambling section that I put together, is that our macro portfolio is still crushing the SPY currently into 2026. It's up 10.29%, even with those huge drops that we felt in gold and with the struggling S&P 500 over the past few weeks. All right, I've been talking for a long time already, so I'm going to let you just go and finish reading the newsletter. But I get into some great data about the current sector performance that we've seen. Communication services down 3.7%, tech down 2.87%, healthcare down 2.29%, all while basic materials are up 3.16%, industrials up 2.05%, energy up 2.04%. So very clearly a market regime shift happening there. Of course, returns from big tech stocks last week: Amazon down 12%, Meta down 7%, Microsoft down 6%. And of course, on the other side of the coin, we have Walmart up 10%, JP Morgan up 5%, Berkshire Hathaway up 5%, Exxon up 5%, Caterpillar up 10%, Johnson & Johnson up 5%. So it's very clear that there's a sort of regime shift that's happening now, but I'll let you guys go read about it. I have a couple of great charts in there for you. The S&P 500 CAPE ratio chart is in there, and I do a little bit of explaining about what that means. The Buffett indicator chart is in there, showing that we are quite overvalued at the current moment. I've also got the U.S. Treasury spread between the 10 and 1 year, and then of course a little bit of outlier events talked about as well. Amazon, AMD, gold and silver, crypto, and then a merger on that list as well. And then I note some large insider transactions that matter quite a bit. A big one that you should be paying attention to is Standard Aero. Around $1.5 billion sold of that company. And if you add all the transactions together, I think it's around 1.8 billion, potentially even 2 billion, sold around $31 and $30. And so, interesting to see that. And a lot of times we don't highlight insider sells because insiders could sell for any number of reasons, but that seems very, very large and somewhat out of nowhere. And lots of other sells happening right now as well. And you saw that with the buy-sell ratio earlier, but in general, it's something worth watching. Our stock research, we've done 16 total picks. We've got 14 closed trades, I think. 16 picks, 12 closed trades, 4 open positions. That's right. We've got 10 winners and 2 losers that have been closed. Our average return for those closed stocks is 24.3%. And for our closed businesses, we have an 83% win rate. So if you're interested at all in any of the stock research reports we send out, one-off stocks that we think could be good investments, go and check that out there. And last but not least, our portfolio information is up for anybody who wants to go pay attention to any of that. We just recently surpassed $1.5 million in assets under management on the Autopilot platform. So if you're not copy trading us there, you need to go and do that now. The returns we've had there are just impeccable. So make sure you go and follow that up. But make sure that you read as well some of the changes that we're potentially going to make to the flagship fund, to the tech-focused growth portfolios this coming week, at the end of the week or potentially next week. We're going to probably index higher on some of our solid performing names and kind of cut a little bit of the weed action out, some of our underperformers. But in general, rough week. I expect this week to be just ridiculous in terms of returns for a lot of our portfolios. I don't see a lot of bad news hitting the timeline that could potentially drag performance down. So unless the AI narrative continues here, we should look pretty good. And as always, we've got our weekly picks at the very bottom. Currently, and this is just ridiculous, we're up 82% since we started doing that, I think in July of 2025? I'm not sure exactly when we started. We've been doing it for 82 weeks. So, closing in on a year and a half here, which is just crazy, or maybe even surpassing a year and a half. Regardless, go and check those weekly picks out. We give expected return numbers and we track all of it on our website as well. And so we'll close out those trades if they hit our expected return. We'll also close out those trades if they hit our expected loss, which is 1% for every stock every week. So go and check all that stuff out. I know I rambled a lot today. Feel free to email me, thesimplesidenews@gmail.com. You can also DM me on Substack. You can also comment in my YouTube. You can leave a comment on Spotify. I try to pay attention to as much of that as I can, and I will try to get back with you and let you know what's going on wherever it is that you reach out to me. And I look forward to seeing you all next week.